This is the story of how a viral financial claim gets monetary policy completely wrong. The Federal Reserve isn't invisibly erasing $38 trillion in debt, and understanding why that's impossible requires looking at what's actually happening with America's balance sheet. That $38 trillion figure you keep hearing about represents the current US national debt as of January 2026, nothing more. The debt isn't being erased or disappearing, and in fact, it's growing at roughly $6 billion every single day. What people are confusing here comes down to a fundamental misunderstanding of how the Federal Reserve operates, what happens when government bonds mature, and the difference between shifting who owns the debt versus canceling it entirely. We're going to break down what's really going on with the Fed's balance sheet, why the mechanics matter more than the headlines, and what this means for the American economy going forward. October 23rd, 2025 marked the day US gross national debt crossed $38 trillion, which happened during a federal government shutdown. By January 2026, that number had climbed to approximately $38.43 trillion. The breakdown tells you where that money actually sits. Debt held by the public, meaning private investors, foreign governments, banks, and pension funds, accounts for $30.81 trillion, or about 80% of the total. Intragovernmental holdings, which is money the government owes to itself through programs like Social Security, make up the remaining $7.62 trillion, or roughly 20%. Our debt to GDP ratio now sits at about 120%, which means the total national debt exceeds our entire annual economic output by 20%. Now here's where the erasure claim falls apart completely. As of late 2025, the Federal Reserve holds approximately $4.19 trillion in Treasury securities, which represents just 11% of total gross debt or 14% of debt held by the public. Everyone else holds the remaining 86 to 89%, including domestic investors, foreign governments, mutual funds, insurance companies, and individual bondholders. When you see headlines about the Fed erasing $38 trillion, the math exposes the problem immediately. The Fed holds $4 trillion, the total debt is $38 trillion, and these numbers aren't even close to matching up. After extensive research across credible financial sources, no legitimate analyst claims the Fed is erasing $38 trillion. This framing appears to originate from financial commentary that conflates the total debt figure with Federal Reserve operations, which makes it clickbait sensationalism rather than accurate economic analysis. What the Fed is actually doing goes by the name Quantitative Tightening, or QT, and it operates through something called passive runoff. The mechanics work like this. Treasury securities held by the Fed eventually mature, and when they do, the Treasury Department pays the Fed the principal from the Treasury General account. Under normal circumstances, the Fed would reinvest those proceeds in new securities, but under quantitative tightening, the Fed doesn't reinvest these proceeds at all. And that's when most headlines miss the crucial part. The Treasury Department doesn't have infinite cash sitting around waiting to be deployed, so when the Fed doesn't reinvest, Treasury must issue new debt to private investors to replace those maturing securities. The Fed's assets decrease and bank reserves decline and liquidity drains from the system, but total federal debt remains exactly the same. What changes is who owns it, as the debt shifts from the Fed's balance sheet to private holders. This process is fundamentally different from debt cancellation. The New York Fed states explicitly that Treasury rollovers describe the process by which principal payments from maturing Treasury securities held by the SOMA are reinvested in newly auctioned securities, and during QT, this reinvestment simply stops up to specified monthly caps. Those caps change multiple times over the QT period. Between June and August 2022, the Treasury cap sat at $30 billion monthly, while the mortgage-backed securities cap was $17.5 billion. From September 2022 through May 2024, those caps increased to $60 billion for Treasuries and $35 billion for mortgage-backed securities, which represented the most aggressive pace. The Fed then slowed things down by reducing the Treasury cap to $25 billion in June 2024, then dropped it again to just $5 billion in April 2025. December 1st, 2025 marked the end of quantitative tightening entirely, with full reinvestment resuming after that date. The full arc of the Federal Reserve's balance sheet expansion and contraction tells you why all of this matters so much. Before the 2008 financial crisis hit, the Fed's balance sheet stood at around $900 billion. Emergency lending and asset purchases in response to the crisis ballooned that number to roughly $4.5 trillion by 2014, and by February 2020, just before COVID, it had declined slightly to about 4.0 to 4.2 trillion. The pandemic response changed everything. Between March 2020 and March 2022, the Fed launched the largest quantitative easing program in American history, with the balance sheet peaking in June 2022 at $8.93 trillion, which represented 36% of GDP. This expansion exceeded QE1, QE2, and QE3 combined, and at the peak, the Fed was purchasing $120 billion in securities every single month. $4.6 trillion got added to the balance sheet during the COVID-era expansion. To put that in perspective, approximately 40% of all dollars ever created in US history were created between 2020 and 2022, with $6.2 trillion added to the M2 money supply. February 2021 saw the M2 money supply increase 26.9% year over year, the highest growth rate since modern record-keeping began. Quantitative tightening removed approximately $2.2 trillion from that June 2022 peak over the next 3.5 years. As of January 2026, the Fed's balance sheet stands at roughly $6.5 to $6.8 trillion, or about 22% of GDP. Treasury securities account for roughly $4.2 trillion of the current composition, while mortgage-backed securities make up about $2.1 trillion. Total securities held outright equal approximately $6.3 trillion. And here's a staggering detail. The Fed still holds over 30% of all outstanding treasuries with maturities of 10 years or longer. The reverse repo facility, which allows money market funds to park cash at the Fed, peaked at $2.5 trillion in late 2022. As of November 2025, it had essentially drained to near zero, with just $1.6 billion remaining. Much of the Fed's quantitative tightening got absorbed by this facility declining rather than bank reserves falling, which is a distinction that matters because it helped avoid the kind of market stress we saw back in 2019. Could the Fed simply cancel the debt it holds even if it wanted to? The answer is no, and 3 fundamental barriers prevent that from happening. The Banking Act of 1935 creates a legal prohibition against the Federal Reserve purchasing securities directly from the Treasury, which means all purchases must occur in the open market from private holders. This prevents direct debt monetization, so the government literally cannot print money to pay off its own bills. Reversibility requirements create the second barrier. Quantitative easing, as practiced by the Fed, is technically not debt monetization because the operations are reversible, and the St. Louis Fed notes that using interest-bearing reserves to buy back interest-earning Treasury debt is merely exchanging one government liability for another. What that means in practice changes the entire picture. When the Fed buys treasuries, it credits banks with reserves, but unlike historical money printing, the Fed pays interest on those reserves. That rate currently sits at 4.4% as of December 2024, which means banks earn returns holding reserves at the Fed. And these reserves function similarly to short-term government debt rather than free money creation. The circular payment reality creates the third barrier. The Fed earns interest on its Treasury holdings and normally remits those profits back to the Treasury. But here's what most people don't know. Since September 2022, the Fed has operated with negative net income. The reason comes down to the Fed paying higher interest on reserves than it earns on older securities purchased during the low-rate era. Cumulative losses have reached approximately $225 to $243 billion, recorded as a deferred asset on the Fed's balance sheet. Remittances to Treasury have been suspended, and projections show they won't resume until around mid-2027, which means not only is the Fed not erasing debt, it's actually costing the Treasury money right now. Real-world consequences of all this monetary expansion and contraction show up in 3 main areas. The inflation connection is undeniable when you look at the numbers. Core PCE inflation exceeded the Fed's 2% target for 55 consecutive months through late 2025, and while quantitative easing wasn't the sole cause, it was a major contributor to the surge in money supply that preceded the inflation spike. Interest rate effects tell another important story. BlackRock analysis found that the Fed's balance sheet currently suppresses 10-year Treasury yields by over 2 percentage points, potentially as much as 4%. This helps explain why the economy remained resilient despite aggressive rate hikes, though quantitative tightening has delivered only 0.25 to 0.5% of tightening versus quantitative easing's 1.4 to 2.9% of easing. The effects are asymmetric in a way that matters. Government borrowing costs have exploded, and that's where the rubber really meets the road. Fiscal year 2024 saw interest expense on the national debt reach $881 to $909 billion. Fiscal year 2025 projections put it around $970 billion, and fiscal year 2026 projections climbed to $1.22 trillion. Interest payments increased 83% from fiscal year 2022 to 2024, which means net interest has nearly tripled since 2020. Interest now exceeds both Medicare and defense spending, second only to Social Security in the federal budget. November 2025 data shows the average interest rate on marketable federal debt at 3.38% compared to 1.58% 5 years prior. Every percentage point increase in average interest rates adds roughly $380 billion to annual interest costs, and as old low-rate debt matures and gets refinanced at higher rates, this number will keep climbing even if rates don't rise further. Depending on who you ask, the Fed's actions over the past 15 years represent either necessary crisis management, reckless monetary expansion, or something in between. Mainstream consensus among economists holds that quantitative easing is a legitimate monetary policy tool distinct from monetization because it's temporary, reversible, and inflation targeting. The Fed emphasizes repeatedly that it cannot and does not print money to pay off debt, and most academic economists reject claims that QE constitutes debt erasure. Austrian economists, following the Mises Institute tradition, offer a harsher critique, arguing that Fed monetary expansion sets in motion the menace of the boom-bust cycle. Their view says artificially low interest rates cause male investment that must eventually be liquidated, and QE distorts price signals and redistributes wealth in ways that make the community poorer rather than richer over the long term. Modern monetary theory proponents take a different approach entirely. They argue that governments issuing their own currency cannot default and that only inflation constrains spending, but this view was unanimously rejected by leading economists in a 2019 Chicago Booth survey and remains a heterodox minority position. Treasury Secretary Scott Bessent offered particularly sharp criticism in December 2025 when he called the Fed the engine of inequality. His argument was that QE created perverse incentives for fiscal irresponsibility and disproportionately rewards asset holders while leaving wage earners and lower income households behind. And the data supports his concern since the wealthiest 10% of Americans own 89% of stocks, with 53% held by the top 1% alone. Fiscal sustainability warnings are growing louder across the board. Stanford SIPOR warned in 2025 that the US may be moving from the green light region to the red light region of debt sustainability. The Government Accountability Office states bluntly that the federal government faces an unsustainable long-term fiscal path. While the Congressional Budget Office projects interest payments rising from 3.2% of GDP in 2025 to 6.3% by 2054. September 2019 provides an important historical lesson that explains why the Fed approached this round of quantitative tightening so cautiously. During the first attempt at balance sheet reduction from 2017 to 2019, reserves fell to approximately $1.4 trillion. September 16th and 17th of 2019 saw overnight repo rates spike from 2.43% to 10% intraday, which meant the financial plumbing of the entire system nearly seized up. The Fed had to inject $75 billion daily in emergency liquidity and eventually ended quantitative tightening entirely. Several safeguards got implemented this time around to avoid a repeat. The Fed slowed the pace twice before stress emerged rather than reacting to a crisis, and current reserves at roughly $3.3 to $3.5 trillion sit at double 2019 levels. The standing repo facility was established as a permanent backstop. The overnight reverse repo facility absorbed much of the QT impact before bank reserves declined, and the Fed committed to stopping QT somewhat above the ample reserves level. December 2025 saw quantitative tightening end with no significant market disruption, which counts as a success compared to 2019. But this also means the Fed's balance sheet will remain elevated at roughly $7 trillion indefinitely, nearly double pre-COVID levels. Bringing this full circle means answering the original question directly. Is the Fed invisibly erasing $38 trillion in debt? Absolutely not. That $38 trillion figure is simply the current national debt, a real and growing fiscal challenge that poses genuine long-term risks to economic stability. The Fed's $4.2 trillion in Treasury holdings represent about 11% of this debt. And when those securities mature, the debt isn't cancelled because the Treasury must find new buyers in private markets. What quantitative tightening actually accomplished was shifting $2.2 trillion in Treasury holdings from the Fed's balance sheet back to private markets over 3.5 years. This represents a normalization of pandemic-era emergency measures rather than debt elimination, and the total debt continued growing throughout this entire period. Genuine concerns about Fed policy deserve serious discussion. Wealth inequality effects are real, moral hazard is a valid concern, fiscal dominance, risks are growing, and long-term debt sustainability is deeply uncertain. But that discussion must be grounded in accurate understanding of how monetary policy actually works. The Federal Reserve cannot legally, technically, or practically erase government debt. The mechanics don't allow it, the law doesn't permit it, and the accounting doesn't support it. Anyone claiming otherwise is either misunderstanding or misrepresenting monetary policy fundamentals. What we're left with is a $38 trillion debt that must be paid, refinanced, or defaulted on through conventional means. The Fed's balance sheet operations change who holds that debt and at what interest rates, but they don't make it disappear. Understanding that distinction is the first step toward having honest conversations about America's fiscal future.